Hi there. Welcome to Trading Day. I'm Andrew Bell. Happy Friday. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Canadian retail sales were up 1.3% in November compared to the previous month. That's according to Statistics Canada. The increase was led by gains at food and beverage retailers. Core sales climbed 1.6%. We spoke to an economist on what these stats say about current Canadian spending habits.
We've seen that retail sales have really just sort of been a bit of a zigzag pattern sideways throughout the year after a very strong acceleration in 2024. So ultimately, Canadian consumers, spent a lot last year. There are a lot of reasons for that. HST, GST holiday, motor vehicle rebates, particularly for EVs. And so ultimately, Canadians, given all of the uncertainty and the relative weakness in the labor market, we've seen Canadians just sort of, stay on the sidelines.
Shares in chip giants have moved up today, or at least we're talking about Nvidia, AMD, and Taiwan Semi. Bloomberg reported that China has told the country's biggest tech firms, including Alibaba, that they can prepare orders for Nvidia's powerful H200 AI chips. This seems to suggest that Beijing is close to formally approving imports of those components that are seen as essential to powering AI. China's ambassador to Canada says allowing a limited number of Chinese electric vehicles into the country could lead to new auto jobs and cheaper cars. These comments come as Ottawa faces criticism over a deal that was signed by the Prime Minister and the Chinese leader Xi Jinping. Ontario Premier Doug Ford has urged Canadians to boycott all Chinese EVs. He says the vehicles put thousands of auto sector jobs at risk. There's a look at the TSX. Once again, precious metals stocks surging after gold and silver hit new records. But you can see our market pretty flat right now. And let's have a quick look at the U.S. markets. Usually when the chip stocks do well, it encourages investors. But again, both big indices, the S&P 500 and the NASDAQ Composite, fairly flat right now. It's a big day for silver, with the price topping $100 US an ounce for the first time. And that extends this scorching rally in precious metals, built in part on a surging demand for haven assets and frenzied buying globally. Let's get more from Michael DeHal, Senior Portfolio Manager at DeHal Investment Partners. What can we say about this gold rally that hasn't been said already?
Yeah, like you mentioned, it's been soaring since the beginning of the year. Gold's up almost 15% the last 2 weeks. Mm-hmm. Silver's, I think, up over 40%. Obviously, what's happened in the last couple of weeks with geopolitical events, whether it's Venezuela, the Greenland issue earlier this week, has caught a bid for the commodities markets, in particular gold and silver, as those metals continue to be, a risk, off-risk safe haven for investors.
Silver in particular has gone ballistic. And this week we saw the price ratio of silver to gold dropping to only 50. And that's the highest relative price for silver in more than a decade. Could silver be in a bubble, do you think?
We think it is. Gold, it's more justified, the move in the gold prices over the last couple of weeks, right? Where silver is still kind of unclear why silver is surging so much relative to gold. And we do think that, these levels could, we are in some sort of bubble territory.
Would you be even tempted to put on a short silver trade and a long gold?
Well, we to be honest, we don't short. We are cautious with the move in silver, right? Mm-hmm. So I would definitely use caution. Like I mentioned, silver's up over 40% just the last 2 weeks, right? So there has to be some kind of consolidation coming anytime soon, right? Mm-hmm. And if geopolitical risks, simmer down, and remember, over the next week or two, we're going to see some the shift in the markets will be more towards earnings season, and obviously the central bank decisions for the Fed and the Bank of Canada.
Look at that silver chart. It's a parabola just going straight up.
Yeah, it's phenomenal. It's just these moves, right? Just a couple of years ago, silver was about $33, and now it's over 100. As a Canadian investor, it's great for Canadian markets to see, gold and silver shine respectively, right? Our TSX is up well over 4% just year to date, right? So it's one of the best performing markets globally.
Would you recommend a minimum weighting or a small weighting in precious metals at all time?
Yeah, of course, yes. You have to be diversified, right? We are recommending to clients have a diversified portfolio coming into 2026, where we're going to see increased geopolitical events around the world, possibly reinflation flaring back up. So you want some exposure to commodities in your investment portfolio, and having that diversification among different sectors and asset classes is a key thing to write on 2026.
What would be a preferred way of holding precious metals for you? Would you buy an ETF just holding the metal? Would you buy gold mining stocks?
We prefer the gold mining stocks. We think the gold miners, especially the larger cap gold miners, do have great free cash flow and able to generate good free cash flow, especially the prices where the commodities, the underlying bullion is trading at.
I wonder, will we see investors bugging the gold companies? Give us a special dividend here, because what are the cash they're amassing at this point?
Yeah, exactly, right? So these gold companies, either they got to do share buybacks, special dividends, or look to reinvest into their operations. But I do think shareholders will be commanding some kind of special dividends given the prices of these prices of the bullion.
What's your view on copper? Because it's at or near record highs too. Maybe we could put up a 10-year chart.
Yeah, copper, similar to the other two metals, has definitely been on a scorching tear as well. But copper is also used in different components, whether it's in EVs, manufacturing, phones, and things like that, right? So copper could also be a play on demand on manufacturing, right? So with the U.S. really looking to onshore manufacturing, that can catch a bid for copper prices.
I wonder, will we see Capstone Copper has been plagued by a strike in Chile, and I wonder, will the other miners see the unions getting more aggressive, because they can read that chart as well?
Absolutely, right. So that's always a risk for some of these mining companies, right? Their employees going on strike, kind of what we've seen.
Just with a highly cyclical, there's Capstone Copper. So despite the strike, stock doing just fine. When you look at a metal like copper, is it one that you would just hold for a decade or more, or a mining company that you like, or would you try to move in and out? Is it a stock for kind of visiting for a while, or a commodity for visiting and then leaving?
Yeah, like a copper stock, they're more cyclical plays, right? So it's more of a tactical play in your portfolio, right? So it's something that you buy for a short period of time, kind of ride out the wave for these companies to produce great free cash flow, and then get to exit out at the right time, right? So it's more of a tactical for copper versus a gold or a silver equity.
We are seeing more commodity ETFs come out. They're tricky because you've got to be rolling over futures and stuff. Is that an area that you've visited? Have they caught your attention? We
do have clients that are interested in the underlying commodity ETFs, right? So again, if it fits within that portfolio, within that asset allocation, we will definitely look at it.
Yeah, they're still not that big. Well, the precious metals ETFs are huge, but not the copper ETFs.
Not the copper, no, exactly not.
Yeah, it is interesting though. ETFs have made it a lot easier to invest in futures, for example.
Absolutely, yeah, and especially the U.S., right? You got GLD, which is a gold ETF, right? A lot of investors globally invest in that particular ETF, just get the exposure to the underlying price of gold.
When you hear from clients these days, or you sit down with them, what's their number one concern or worry?
Geopolitical risks, right, affecting the portfolio, in turn affecting volatility coming back to the markets, right? Kind of what we've seen last April with the trade tensions, right? We kind of seen that earlier this week with the Greenland issue, right? So that's what keeps clients up at nighttime or asking us questions: is our portfolio protected against these shocks to financial markets? Michael, thank you very much indeed. Thank you. Michael DeHaal is Senior Portfolio Manager at DeHaal Investment Partners. Coming up, Chinese EVs are headed for our shores. We look at possible speed bumps for the auto industry.
Coming off that new trade pact with China, or I guess you could call it an agreement, it's not a full formal agreement. The Prime Minister announced that roughly 50,000 electric vehicles will be coming to Canada from China. And that announcement ruffled feathers both inside and outside the auto industry. Ontario Premier Doug Ford calling for an all-out boycott of Chinese EVs. Let's get more from Sam Fiorani, Vice President at Auto Forecast Solutions. Sam, thank you very much indeed for joining us.
Great to be here.
And I guess we should, people know this, but we should start off by just reminding people these 40,000 or 49,000 Chinese EVs would only be about 3% of our auto market.
Absolutely, yeah. This is a breaking into the market for the Chinese brands. It's not going to be a substantial number of vehicles, but it will give them a foot in the door.
There's a lot of talk. Even the Ontario Premier said they're not going to invest here. And do you think they will? Will they spend significant dollars on assembly or supply chains here in Canada?
The Chinese want to be in this market. They need to get in here to expand their footprint worldwide. And so getting anything into the Canadian market will help that. Once they get in and once they get the brands established, they're going to need to build locally in order to expand that beyond the current 49,000 and eventual 70,000 units that they're allowed.
Mm-hmm. And what do you think? Is this... Excuse me. I know this was part of a peace deal over Canadian agricultural products, but even ignoring that, if possible, is this a smart move by the federal government to give the Chinese a toehold here?
In order to build the infrastructure for manufacturing in Canada, this helps. This brings in new players. The Canadian automotive market has been limited to the Detroit 3, Honda, and Toyota, and there wasn't a lot of new investment in the area. But the trade deals with the United States haven't helped. So finding some alternative sourcing, which would be a Chinese manufacturer, helps bring that along and generate it into the future. We can see new plants coming up in the next 5 to 10 years, potentially, and potentially filling some of the existing plants with Chinese vehicles as well.
Of course, the auto industry in North America says, well, they're heavily subsidized, but you often hear that in trade disputes. Oh, the other side is subsidized. And of course, our own auto industry is not, or the North American industry isn't so reluctant to gobble up subsidies themselves. In a way, I think this is a good move in the sense that our auto manufacturers have not produced the kind of electric vehicles that have been big sellers. Maybe we should give the Chinese a chance.
We need entry-level vehicles, and entry-level electric vehicles help a lot in the transition to electric vehicles. Electric vehicles will be the future. They're not going to be the future in the next 5 years, probably not 10 years, more likely in the 2040s. In order to keep the auto industry moving forward and growing, you're going to need to switch to electric vehicles eventually. Having the Chinese break into this market, bring in entry-level models, appeal to people who were not able to afford the vehicles that were on the market previously. This will expand the market and eventually grow it to a point where the electric vehicles are a substantial part of the Canadian market.
The Chevrolet is bringing back the Bolt, apparently, for 2027, and it's priced at about $40,000 before freight and pre-delivery. I love the way they put on these charges. I'm not sure how long they actually plan to go on selling it, but it looks like the big US companies can produce a reasonably priced small electric car.
Models like the Bolt were designed to get the incentives that the federal government in the US had previously, and the governments in Canada as well. They were designed to have that $7,000 padding.
Oh, okay.
Unfortunately, in the U.S., it went away. So now this vehicle has to stand on its own, and that's why GM has decided it's going to be a limited production vehicle. We're going to see that vehicle going away in the next 2 years.
Yes. From what I've seen, the production will actually last for only 18 months. It sounds, why are they doing that? Why would they launch a car for such a small, short period?
It was intended to be built longer. It was intended to be built alongside the U.S. $7,500 incentive. With that gone, now GM has to carry that $7,500 that would have been padded into the price before. Selling it at $30,000 is going to lose money for General Motors. And so they promised to build it. They have the tooling set up. It's going to go away in 18 months.
You're right. 40,000 was the price I heard for Canada. Before these myriad charges that they put on, it's always impressive. You gave us a kind of a long-term outlook. You said electric cars are ultimately the future, but it could take a decade or more before they become a huge part of the market. Why is that? Because they're just better in some ways, lower maintenance, for example?
They're easier to put together eventually once they've designed vehicles around electrification. We're going to see them being easier to build, easier to update. We know they're emissions free. There are a lot of reasons why these are better vehicles. We've seen the performance of them. They're quicker. They're more enjoyable to drive. They make less noise. They have all kinds of benefits that gas vehicles do not have. It's just going to take a long time because roughly 80% of the market can't be convinced that they can drive an EV every day. And so making those people understand that an EV works into their lifestyle will take a long time.
It's interesting you mentioned the quiet, getting the noise down for one thing, although that's become a sound of the 21st century, hasn't it? The odd kind of high-pitched hum from the electric cars. Thanks very much, Sam, for giving us the time.
Great to be here.
Sam Fiorani is VP at Auto Forecast Solutions. Coming up, we did get some mixed signals on Canada's retail sector today. Lindsay Biscaya will help sort it all out after the break. We're getting some mixed signals on the health of Canada's retail sector. Let's get more from Lindsay Biscaya. Lindsay.
And so for the month of November, Andy, it shows that sales are increasing, but really just barely. We saw a 1.3% uptick in sales over the month of November, which is more than what economists were expecting. So we'll go through that. First of all, it was led by Alberta, had the most when it comes to sales, had the highest sales, mostly in motor vehicles and parts. New Brunswick had the lowest in sales. But what we're really seeing is kind of like the driver here is the food and beverage sector, which in the month of October took a bit of a hit. So it was interesting to see the rise here. Most of that came from sales of beer, wine, liquor sales. They were up more than 14%, but it's also because there was some labor disruptions in BC in October. And so because sales were down in October, potentially we saw a higher increase in November as well. Gas sales up 2%. Online sales, this is an interesting one. E-commerce sales relatively weak. They dropped in the month of November, 2.8%. Not a real reason as to why here. Some economists are saying it could be part of that kind of buy Canada mindset that we've all gone into. Less people are shopping maybe online for American stuff. It's easier to maybe access Canadian things just by foot traffic. Others, it might just be like just a shift in terms of when people are buying. Maybe people for Black Friday even or for the holiday shopping season started buying in October or waited until December. There's no real reason, but that was an interesting little note as well.
And then we've got estimates out, early estimates for December, and it's showing a bit of a decline. Yes,
so flash estimate showing a drop of 0.5% for the month of December. So assuming that this flash estimate is right, that would be a 0.2% drop in the fourth quarter of 2025. So really showing that people, compared to the beginning of 2025, at the end, people were spending a lot less, which does make sense when you think about where we went in 2025, right? It's hard to remember a time when we weren't talking about tariffs and trade, but we weren't at the beginning of 2025 as much. And so people were buying more and feeling a little bit more confident in terms of their spending. And in terms of the Bank of Canada, we've got a rate decision coming up next week. With these numbers today, most economists are saying they don't think that anything's going to change here. It's not expected to... The Bank of Canada isn't expected to cut rates. They've said they're going to hold things steady. Most economists think that that's still going to happen. But there's a couple of metrics in terms of what might happen for the rest of the year when it comes to potential rate cuts. And I know you were speaking with Earl Davis earlier from BMO, and he was talking about some of those metrics. One of those is employment, and he explained that a little in more detail. Take a listen.
They look at employment because that reflects the consumer's ability to spend, whether it be on mortgages, rent, and most especially goods, consumer goods. And as you've seen, we've been getting surprisingly strong numbers on unemployment. The unemployment rate's still fairly elevated, but it's not as elevated as the market was expected. So again, another reason to be on hold.
So employment, one of those metrics, inflation, of course, another one. We're still slightly above the 2% target that the Bank of Canada has kind of set for inflation. But that's obviously just playing into the whole, like it shows that households are feeling that squeeze when it comes to maybe spending less.
Lindsay, thank you very much indeed. Lindsay Biscaya. Okay, the AI boom is everywhere, but some of it appears to be illusory, with money flowing between a few players, some of whom have yet to show a profit. If it's a bubble and it pops, the consequences for the economy and lots of people may be dire. This week's Bloomberg Doc dives in.
From Wall Street to rural America, today's AI is the economy, and markets have priced it like a miracle that can't fail.
Investors are really banking on incredible growth. Microsoft, Meta, Alphabet, they are just committing billions and billions of dollars to capital expenditures and expected to continue to, raise those numbers over time.
The AI boom is more than just software, it's construction. So that's building out the data centers, that's securing the energy that's needed, the water that's needed.
But in this burgeoning industry, what goes around doesn't necessarily come around.
A precarious investment strategy is emerging.
Multi-billion-dollar circular deals.
NVIDIA will invest as much as $100 billion in OpenAI.
The merry-go-round of money continues.
Huge sums of money are just being passed between these enormous companies that are pouring hundreds of billions of dollars into the promise of AI.
And the promise is huge.
About 80% of U.S. businesses use AI. So this is a structural shift, like electricity or the internet.
But AI, with all its potential, remains largely unproven for profitability.
Probably the biggest question in San Francisco right now is, are we in an AI bubble? And if we are, then, well, how big is this bubble and how bad would it be if and when it does burst?
So, is this the dawn of a new age of AI-powered growth, or the biggest bubble ever?
A circular deal is when companies are basically blowing money, products, services in between two of them.
NVIDIA has said it's going to invest up to $100 billion in OpenAI. At the same time, OpenAI is a major customer of NVIDIA's services, of their chips. To make it even more complicated, there are also sort of other middlemen. One example is Oracle. OpenAI sometimes will lease compute from Oracle. And so you have Oracle being a customer of NVIDIA. So you can see how there can be more sort of arrows back and forth between these companies.
But NVIDIA, OpenAI, and Oracle are just part of the web. The full picture entails a who's who of the AI landscape.
This money is kind of spinning around the same companies, and that's why people are worried.
I don't think there's anything inappropriate about that in principle. Now, if you start stacking these where they get to huge amounts of money, then yeah, you can overextend yourself, of course.
It becomes kind of symbiotic, and I think that's sort of the concern that's cropping up now, is if one of those companies stumbles or doesn't do well, does the whole thing fall apart?
A lot of this investment is going straight to the build-out of data centers across the nation.
We're really in an infrastructure build-out arms race.
Have a look at construction spending in 2025. It's down in most sectors, but not data centers or power stations.
We're seeing a lot of companies that are sort of the picks and shovels of the AI industry. They're out there actually, digging into the ground. One recent estimate from Morgan Stanley predicts that companies will spend $3 trillion on AI data centers. That is obviously a major bet.
If you're in the business of selling picks and shovels, you are living it up. You are getting all the money you need, and there's more demand than you can meet.
We're currently in a facility that was once upon a time a textile
facility, one of the largest ones on the eastern seaboard, about 1 million square foot. We realized we could actually repurpose it as a data center. There is an insatiable demand for building data centers, for making sure that we have the power to build the data centers, the megawatts, the infrastructure, and the expertise. We don't see any slowdown in that for a long while. When it comes to artificial intelligence, time is not your friend. So if you can get up and running in 6 months using a retrofit format versus a greenfield format, which is starting from scratch, which takes up to 2 years, that's a much better proposition.
All these data centers need power. The growth in utility costs is outpacing inflation.
Utility companies have done really well, especially ones that are providing energy to data centers. Construction stocks have done well.
But building fast isn't always built to last.
You don't just build a data center, switch it on, forget about it, and make money. You have to keep on investing to keep that technology working. Otherwise, it will quickly become useless to the people you want to sell it to.
And so far, all major AI projects are operating at a loss.
The problem is, every time someone uses ChatGPT, OpenAI likely loses money.
Those OpenAIs and Anthropics of the world are not yet profitable.
Sam Altman says OpenAI should be able to break even around 2029, 2030. Given the amount of cash that company is burning through right now and the amount it still needs to spend to build the data centers and pay for the computing power to do what it wants to do, that feels like a tall order to me.
There's some concern about whether the AI startups are actually able to pay their bills when they're racking up these huge commitments to spending on data center infrastructure.
These AI data center companies, they are the kind of canary in the coal mine. They are the ones where we perhaps see on their balance sheet any first sign of companies pulling back from needing as much AI data center capacity.
Right now, all the companies, they're all saying that the demand for AI products is really, really high. If that were to change, if demand were to suddenly weaken, that would become an issue.
To understand the stakes of today's AI boom, you don't need a crystal ball, just a quick trip down memory lane.
You've got mail.
In 2000, the dot-coms promised a brave new world. Instead, we got wiped out savings, empty office parks, and $5 trillion in vanished value.
The worst hit shares around the world have been the technology stocks, including the dot-com companies.
Even the strongest companies in that era took years to recover. Amazon, one of the big, great, famous survivors, its share price didn't recover for another 8 years after the dot-com crash happened. Cisco, one of the picks and shovel companies, it took them 25 years before their stock price recovered.
There are definitely some similarities. One is that there is circular deal making in both instances. The question is this bubble going to get to a level that goes beyond just kind of the normal ups and downs of tech booms, but actually has major consequences for the economy?
The dot-com boom was devastating for the economy, but I don't think it would compare to the far-reaching effects of the AI boom collapsing.
The money pouring in has been a huge contributor of growth to GDP, helping boost a U.S. economy otherwise hampered by tariffs and inflation. Everyday Americans are exposed to this risk via 401ks and other investment accounts that hold stakes in many of the big tech companies participating in the spending spree. So does that mean the AI bubble is too big to pop?
There's definitely this question about, are these companies becoming too big to fail? If they were to go down, that could have not just economic consequences.
There is a suggestion this might be like the global financial crisis, where huge financial institutions needed money to survive to prevent a wider collapse of the economy. Then that's obviously a far greater problem for the US economy.
But despite these stakes, many remain bullish on AI because of the evolving nature of the technology itself.
In the dot-com boom, there were companies that were laying fiber optic cable, like subsidiaries of a company were basically all spending in a circle, and it did contribute to the dot-com bubble popping.
But after a while, that became the backbone of internet broadband. And that unused part of all the fiber optics that were built in the 90s actually ended up being extremely important for the internet. And so we think with respect to data centers, if there is potential excess capacity that's being built, those data centers will eventually be used.
There's a scenario here where AI takes longer than we think, and therefore the strongest companies, sure, they'll survive. But in the meantime, there might be a huge hit to their valuations.
Ultimately, this technology is not going to burst. There are certain companies that will not make it, but AI itself is not a bubble. There are real products.
It's clearly the biggest gamble that Wall Street has ever made. And this is a street known for its gambling. This is the wager to end them all.
That's amazing. All right. People scratching each other's back with big spending. That kind of roundabout can only keep going so long. Shares in Intel taking a hit. There's a bit of good news. The company is struggling to keep up with surging demand, but investors are impatient for announcements of actual new customers for their chip fab business. We'll be right back. Investors have been selling shares in Intel today. Mind you, that's after a big run-up in the stock. The chip maker provided what was seen by some as a cautious outlook. Revenue dropped 4%. In the latest 3 months. The company posted a loss, and it does see more red ink in the current quarter as it spends heavily to ramp up production. And it also warned that announcements of new customers for its chip fab business won't come until later this year. Let's get more from Stacy Rascon, Managing Director and Senior Analyst in U.S. Semiconductors at Bernstein. Stacy, thanks very much. Let's have a look at the stock because it did have that big run-up. NVIDIA invested in the company, the U.S. government, and it's really correcting a lot today. Why do you think investors are disappointed?
I mean, let's be honest. It was here a week ago, so let's not get too worked up. Like the stock went vertical into the print on mostly nothing, like mostly on vibes and tweets is kind of what I've suggested. And look, if something goes vertical into an earnings like this, it's got to be perfect. And it wasn't perfect. Although I kind of find it a little surprising. Nothing that they said was different than what they said 3 months ago. 3 months ago, they said they were supply constrained. 3 months ago, they said that Q1 would be like the toughest quarter for those constraints. It would get better after it. So it played out exactly like that. I mean, but that's not for whatever reason where expectations were. And look, I think, the elements that people like, it's been running on, there is a very strong server demand out there right now. And they ramped their new 18A product, and the products that process and the processors that are on that Panther Lake chips look really good. And again, there was some hope that you'd get more information on new 14A foundry customers. But each of those things had a lot of hair on it. There is server upside, but unfortunately, Intel really screwed up. Like they didn't put the supply in place to meet that demand. They misjudged it. They got caught off foot and they can't capitalize. The 18A ramp is going okay, but it's not going any better than anybody thought. And they still said yields are below where they want them to be, and it won't be where they want them to be till the end of the year. And 14A customers, we're still waiting. So, I mean, given the trading behavior of the stock into the print, I don't think it's surprising at all that it's acting like this. It probably shouldn't have been, $55 or wherever it was going into the print in the first place.
What is the 14A chip? Can you remind us, Stacy?
So 14A is their next generation process. And that is the first process that is going to be really specifically designed bottom up to serve external customers. So Intel could make chips for other companies.
Oh, yeah.
And that's a big part of the future bull case is that they will build up this big manufacturing scale on these new advanced processes. But the thing is, it's going to be a while. Like he said that we may hear some news on potential customer engagements for that process, maybe in the second half of this year, maybe in the first half of next year. But even with that, we're not going to see any, even what they call risk production probably till 28. if they go forward with it, and volume production, actual like real revenue probably wouldn't be till the end of 28, maybe even into 2029. Like it's going to be a slog. We've got a ways to go still.
Now they are working on an Ohio project to build chips. It's valued at about $28 billion US. It's been subject to delays. Can you remind us, are they building other chip factories in America?
Yeah, they are. So they have a big one that they built in Arizona.
Okay.
And they're ramping that right now on the 18A, the current new process, 18A. And they've got other factories. They've got a bunch of other factories in Arizona and New Mexico and in Oregon. Ohio is their first new like kind of greenfield installation. And it is delayed because frankly, they don't need the capacity, or they haven't needed the capacity. Ohio will probably be where this future 14A third-party foundry business, if it gets sizable, will sit. But I mean, it's going to be a while. It's been delayed because they don't need it yet. And you have to remember, this is a tough business. Like, you don't just dig a hole and throw $50 billion into it and then sit around and wait for customers to show up. And the company themselves, you know, they've been sort of, especially under the new CEO, Lip-Bu Tan, they've been kind of cautious. They don't want to build out capacity unless they know they have customers that are going to fill it. Because if you dig that hole and you throw money in and there's no customers to service it, then you're screwed, right? So they're being cautious, but they don't have any choice right now.
Yeah, most analysts, it looks like the bulk of the analysts have a hold on the stock, and you're in that camp. You have a market perform.
Yeah.
What could persuade you to go to a buy, Stacey?
So let's be honest. Like I'll say, I've made my career being negative on this stock. We have not been short it. We've been neutral because, look, I actually think the real bull case right now is Donald Trump wants the stock to go up. And I mean, he even sent it up like a couple of weeks ago just on a tweet. That's why I think it's a tough short, because like you can get blown up on a tweet. But at the same time, they clearly have some pretty sizable fundamental issues. It's hard to be bullish from that standpoint as well. And it's going to take time. It's going to take time. We'll see if they can pull it out. But I've sort of made the point, it took 10 years to break it. It's probably going to take 10 years to fix it. That'll be 2030, probably, before we really know for sure. Maybe get some like incremental color 28, 29, but you're not going to really know if it's really like on its direction until the end of the decade, probably. It's a battleship, right? It doesn't turn like quickly. Like
No. That's a good line, though. It took 10 years to break it. It'll take 10 years to fix it. Stacey, we better go. Thank you very much indeed.
Yeah, you bet.
Stacey Rascon, Managing Director and Senior Analyst in U.S. Semis at Bernstein. Coming up, the one and only Christine Dobby, Bloomberg's Canadian finance reporter, will be here with her weekly newsletter, or summary of it, and she's watching reaction to Carney's speech in Davos. Let's check in with Bloomberg Canadian finance reporter Christine Dobby, who writes the Bay Street Edition, a weekly newsletter. Thanks very much indeed for joining us, Christine. You and many people around the world listened to the Prime Minister's speech in Davos. It was controversial. He talked about a rupture in the global power structure. You think to some extent he was sending a message to Canadian CEOs?
That's right. I mean, as you say, this speech was kind of the talk of the week. You know, it seems that the world leader that attracted the most attention at Davos this week was the Canadian Prime Minister. Donald Trump might not have liked that he upstaged him to some extent. And, you know, he's now disinvited Carney in Canada from the peace board that he's assembling. But yes, I spoke with Lawrence Herman, a longtime trade lawyer. He's a senior fellow at the C.D. Howe Institute. And his take was that this was really a powerful message to Canadian businesses as well. You know, really kind of bluntly laying out that without saying, you know, the United States or Trump by name, but that this country is no longer the reliable trade partner that we have become used to. And Herman's point was that Canadian firms need to take a much more deliberate and almost aggressive approach to finding other export markets. You know, this is a theme you and I have been talking about for quite a while now. The example that he raises is South Korea, where we do have a free trade agreement with the country. But while South Korea has expanded its exports to Canada quite a bit over the past decade, we haven't matched that level, and we have quite a big trade deficit with that country. So there's room to grow in places like that if Canadian businesses are really deliberate about it.
Yeah, I mean, the South Korean population is about 52 million. And they have Samsung, one of the world's greatest tech companies. They have car companies. They're kings in pop culture in Asia. What is wrong with Canada?
Yeah.
Why don't we have domestic tech giants like that?
Well, I mean, I guess it depends on who you talk to, right? You know, do we need to have 10 Shopifys or, you know, some people would argue that we do have quite a number of middle-sized tech companies. But yeah, we really haven't made as many inroads in exporting those, you know, those high-tech industries to other countries. Most of our exports to South Korea have been, the expansion in our exports to South Korea have come in the, you know, the traditional metals and minerals space. Mm-hmm. So there's an opportunity for more agri-food and high-tech and services. You know, Canadian exports to countries like that. You know, obviously, we can't replace the U.S. market overnight, mm-hmm. but we've already seen a shift in where our exports are going. If you look at a year ago, in February of 2025, 79% of Canadian exports were going to the United States. This is goods exports. Mm-hmm. And in October of last year, it was 67%. You know, obviously it's not an amazing trend, but and it's going to be a painful transition, but it's something that we have to do. We have to go through.
Just finally, Lululemon, what a gift to the late night talk show hosts. They're now advising people to wear what skin-colored underwear to make up for the fact that their new pants are see-through.
Yeah, and one might suggest you could save some money by just buying pants that aren't see-through. But yes, this has been another product fumble by the company. Their shares were down this week as they temporarily took their Get Low leggings off their website. I believe they are back on sale, as one of my editors, Melissa Shin, remarked that we might be seeing those leggings on the We Made Too Much section or Lululemon sale section at some point not too soon. That's not an official prediction, just a hunch that she had.
Thank you very much. It's always great hearing from you, Christine. You can check out Christine Dobby's newsletter. You go to, it's called Bay Street Edition. You go to bloomberg.com/newsletters. When we come back, we'll take one last look at stocks moving the market. Quick look at the markets. We'll check out the TSX. Mixed showing for Canadian stocks right now, but they are holding above that 33,000 psychological level. Helped, of course, by gold hitting yet another record high. One stock moving today is Aya Gold and Silver, AYA. That one of the heavy traders. And Baytex Energy, the oil producer, also doing well, BTE. Intriguing story here. The French leader, Macron, at the Davos summit or World Economic Forum meeting, wore shades. And people were wondering why. Reportedly, it's because it was to protect a burst blood vessel in his eye. But attention soon turned, as Yahoo News says, to the glasses themselves. He was wearing shades from a company called Henri Julien, and there was so much demand that the brand's website crashed. The brand is owned ultimately by an Italian company called iVision Tech. Its shares jumped. It's a pretty small company, though. If you want those shades, they'll cost the equivalent of $770 US. So we're not talking about Dollarama shades here. But anyway, that's Macron, stylish as any Frenchman is. Thanks very much indeed for watching Trading Day.